In this week's Fastest 4 Minutes in Finance, don't let all-time highs scare you away from the stock market. Hello, and thanks for joining us for this week's segment. I'm Scott Inman. Well, the stock market is setting all-time highs again, making what happened in 2022 a distant memory. But just like the market going down 2 years ago caused worry for investors, the market going up can make us worry too. We're tempted to fall into a what goes up must come down mentality. Now, let's be clear. It's true the market will likely come off those all-time highs, but history shows us it might not go down too far, and it might not last too long. Take a look at these two charts from J.P. Morgan's Guide to the Market. You'll see on the left a graph charting the S&P 500 index going all the way back to 1950. The blue line represents the price of the index, and if you look at the black box at the top of the chart, it shows us that 6.8% of all trading days, the index closed at an all-time high. 29.9% of those all-time highs that were set ended up being a market floor. That means historically, almost 30% of the time that the S&P 500 hit an all-time high, it never went lower than that again. Now, check out the chart on the right. If all-time highs make you worry that the bottom is about to fall out of the stock market, this should change your thinking. These are average returns for the index from 1988 through 2023, sectioned into time periods of 3 months, 6 months, 1 year, 2 years, and 3 years. The blue bar is the return if you invested on any day over the past 35 years. The green line is if you invested at an all-time high. You can see that the returns 6 months later, 1 year later, 2 years later, and even 3 years later are actually higher if you invested at the all-time high. This means that historically, when the market hits an all-time high, it's about to hit more of them. Now, that doesn't mean it will be a smooth ride. Here's one more chart for you. This tracks the S&P 500 back to 1980. The black bar shows the annual returns in each of those years. The red dots represent the largest drops in the index during those years. The chart tells us that on average, the S&P 500 has a pullback of 14.2% every year. Even in the face of that drag, annual returns were positive in 33 of the past 44 years. And look at the far right of the chart. We see what's up in 2024. The index is up about 10% and has only had a max pullback of 2%. The smallest calendar year pullback on this chart is 3. That means if we don't have at least a 3% pullback between now and the end of the year, it would be the first time in the past 44 years that it hasn't happened. Keep in mind the S&P 500 is an index that cannot be directly invested into and is only a benchmark to measure stock market performance. Bottom line here, there is always a reason not to invest, but they are not usually good ones. We should always look at stocks as long-term investments. Betting on the market going down just because it's at an all-time high is not a good bet. Thanks for watching. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.